In this video, I'm going to show you how to use an allowance account for inventory write-downs. So let's say you've got some inventory that originally cost $500 and the net realizable value of the inventory is $380. So assuming we're using the lower cost or net realizable value rule, there's going to be a $120 write-down. Now, I've talked about in another video, there's a couple ways you can account for that. One way is to debit cost of goods sold and then credit inventory. Another way is instead of debiting cost of goods sold, credit like loss on decline in value of inventory and then credit inventory. I don't want to get into that here. Let's just stick with a simple one. We debit COGS and we credit inventory. Now, an allowance account, what we're going to do is instead of crediting inventory directly, we're going to credit an allowance account, which is then subtracted from inventory on the balance sheet. It's like a contra account. So our journal entry would look like this. Okay, so we're still debiting cost of goods sold, and now we're going to credit this allowance to reduce inventory to net realizable value. So this is a contra account. It's still going to, by crediting this, it's still going to reduce total assets. Just like when we credited inventory, that reduced total assets. This is also going to reduce total assets. But instead of reducing the inventory account directly, what we're doing is increasing this account, this allowance account, which is going to be subtracted from inventory. So classic way of doing a contra account. So our balance sheet, the inventory part would look like this. We got inventory at its historical cost, $500. And then we say, okay, minus this allowance of $120. So the net amount of inventory is $380. If we didn't use the allowance method, we wouldn't have any of this. It would just say inventory $380. Now, what are the benefits of doing this? Well, this makes it easier. You can clearly track. You don't have to mess with the original purchase price or whatever of the inventory, the original cost. The inventory still stays in your financial accounting records, your bookkeeping records, at its original cost of $500, and then you just track this allowance account. Now, so let's just say that, so you make this write down, and you say, okay, we write it down by 120. We set up this allowance account. Under IFRS, if the value of the inventory were to go back up before you sell the inventory, you could potentially reverse this. Okay, you could reverse this entry and decrease the allowance account. But under US GAAP, if the value of the inventory goes back up, you would not make a reversal. So that's one difference between IFRS and US GAAP. Basically, under each method or under each accounting system, IFRS or US GAAP, you'll write down inventory, but you'll only have a potential reversal under IFRS, never under US GAAP. So if the inventory goes down, you write it down. Either way, under IFRS, if the value goes back up, you could end up reversing it. Now, what if you were to sell? So in our hypothetical example where we took the $120 write down on the inventories on the balance sheet, net amount of $380, if you were to sell that inventory for $400 cash, how do we deal with this? Well, obviously we're going to be debiting cash for $400, crediting sales revenue for $400. So the parts here in the middle, this is what has to do with the inventory. So the allowance to reduce the inventory to net realizable value, when we originally booked that, it was as a credit. So we got to zero it out. You zero this allowance account out, or you reduce when you sell the inventory. You don't, like if we hadn't sold the inventory yet and it was just year end and it was doing the closing process, you would not just zero the account out during the closing process. You basically reduce and get rid of this allowance account when you sell the inventory that you set the allowance account up for. Okay, so now we've sold the inventory. Okay, we got rid of the inventory, so now we got to get rid of the allowance. So we debit the allowance for $120. Okay, and then we debit cost of goods sold for $380, which makes sense intuitively. Think about it. It's like, so our inventory, the gross amount of our inventory was $500, which we're crediting, but we had already, with this allowance account, it was like we had already pre-expensed, back when we had the inventory write down, we had already expensed $120. And so now we just need to expense the remaining $380. Okay, so that's why our cost of goods sold is $380 instead of $500. That's the whole idea of a write down, is you're taking some of the expense for the inventory, even though you have not sold the inventory yet. Now we've sold the inventory, so we need to take that remaining $380 and we're going to expense that.